Welcome to Financially Speaking, brought to you by Buska Retirement Solutions and its affiliate firms. We offer retirement, tax, and legacy planning from a dedicated family-built team. In today's episode, we'll talk about why understanding your risk tolerance is such an important part of retirement planning, why it can often be smart to reduce your investment risk as you move closer to retirement, and what to do when you've exhausted your emergency fund. And now for our weekly question and answer segment.
Welcome back to Financially Speaking. Today I'm here with Ryan Connor and Kaylee Berenson of Buska Retirement Solutions and Buska Wealth Management. Let's chat about why understanding your risk tolerance is such an important part of financial planning. Thanks for joining us today.
Of course.
Absolutely.
How do I assess my risk tolerance, or how do I look at that when I'm planning for retirement?
Absolutely. So when we look at our risk tolerance, let's talk about what that actually means. So it's how much risk you're comfortable taking within your portfolio, especially as we experience some volatility. When we go through volatile times like we've already had this year, does that cause stress or, some emotional reactions? And if it does, then maybe we should take a look back and maybe lower that risk within that portfolio. There's a lot of factors that do go into assessing your own risk tolerance. A couple of the big ones are going to be looking at what are your goals for retirement and your objectives. Do you plan on maintaining your current lifestyle, or do you maybe plan to fly south for the winter and be a snowbird like most of us would love to do here in Wisconsin? Or maybe leaving a legacy is super important. All of those things you can invest in different ways to make sure that you are going to be able to achieve those when retirement does come. The other thing that you want to look at is your time horizon. Do you have a long time horizon or a short time horizon until retirement? That's going to make a big difference on how much risk you should be taking within your portfolio. If it's longer, you have time to be more risky and you have time to go through those market fluctuations and then still recover from them. Whereas if we're on a shorter time horizon to retirement, then we want to scale back on that risk and we want to have more stable and predictable investments in our portfolio. So those are just a few of the things that you should be looking at, but there is a bunch of tools and questionnaires out there that you can utilize to kind of get a better answer on your risk tolerance. And we do offer one on our website, so it's called the Color of Money Risk Analysis. If you go to our website, retirewithbuska.com, then you click on this little pop-up that says, get your risk score here. You can answer a few short questions and then it'll generate a number anywhere from 1 to 100. And so that number is going to tell you how you feel about being more growth oriented within your investments. So let's say I took that and I got a score of 60. That means that I'm comfortable with 60% of my assets being more growth oriented, and then 40% of my assets I want in safer investments. And so if you go through that and you're still having questions, you can always set up a consultation with one of our advisors to kind of explain that a little bit further and also do a review of your portfolio to see if you're in line with your current risk tolerance.
I suppose that's one thing of not only how do you feel, but how are you set now? What are some common types of risks that people face in retirement?
Yeah, so the one that I think most investors are going to be the most familiar with is going to be market risk.
Sure.
So that is like the type of volatility that Kaylee was talking about, where the price valuations of your investments change depending on various market conditions.
I think 2025 might have brought that one a little more to the forefront.
Yeah. Yes, and so the one that a lot of folks understand is that, like, hey, if I have a lot of stocks or if I have mutual funds that have stocks in them, like, hey, those are going to be more volatile. That's going to be the most common one that folks are going to be familiar with. Oftentimes folks don't understand, though, that bond holdings as well also do have volatility in them because they are going to be what's called mark to market. So the price valuations of them are going to reflect, actually, as if you were selling them right now. And so unless you hold all of them to maturity, or the mutual fund you invest in holds all of them to maturity, you are still going to see price fluctuations within your portfolio. Of course, there are other types of risks that are involved as well. Tax risk is a big one, which is going to be changing of tax rates or the taxability of different types of income you may have in retirement. Legislative risk, which can be alterations, whether that be to income sources like Social Security or to health care benefits like Medicare. And income risk as well, which might be the sustainability of certain types of income that you have. So, maybe you've got Social Security, maybe you have a pension. Well, the stability of you receiving that pension depends on the solvency of the pension fund. So if you have a pension fund that may be a little less solvent, maybe having some issues, then there can be risks entailed there as well.
How can I manage my risk in my investment portfolio? I mean, doesn't investing kind of by nature have a definition of risk in it? Like how do I do that?
Yeah, so when you're investing, you want to make sure that obviously, as you get closer to retirement, we're just lowering that risk within your portfolio. And you want to make sure that as you do that, usually it's about 5 to 10 years before that ideal retirement date. You want to start to tailor back on that and get more conservative, but you don't want to make drastic changes in the portfolio. You want to make gradual changes because you want to preserve the capital that you've already built and maintain that, and then just tailor back and get more conservative as you approach that ideal retirement age. You also want to look at your income streams through retirement. You know, are you going to be having some more stable income streams like your Social Security and then possibly a pension, or maybe you have retirement or rental income that may be income stream that you continue? Then maybe you don't have to touch the portfolio as much. Or are you going to be relying more heavily on your investments? Because if you are, then you definitely want to make sure that you are lowering that risk as you approach that retirement date.
So risk tolerance is a personal feeling. And then the structure of it is also dependent upon income, assets, all these sorts of things. When in the retirement planning process should risk enter the picture?
So from an investing perspective, understanding risk is going to be important basically the entire time. Because like Kaylee talked about, when you're a younger investor, you can tolerate significantly more risk in your investment portfolio.
Sure.
So what you are chasing is good average rates of return. Now, she talked about a period of like 5 to 10 years before retirement. We kind of call that period their pre-retirement. So that is when the risk is really going to change for the individual, and they're going to want to start making sure that their investments reflect the reality they are now entering into. Because the needs and objectives that you have for your funds when you're 25 years away from retirement are dramatically different than what they will be 3 years from retirement.
You don't need them when you're 25.
And so as we go through these changes in our timeline, it is really important to update and make sure that we understand where we need to be from a risk perspective, and also then make sure we can implement those changes in our risk tolerance actually in our investments themselves. Because just knowing and not doing is not actually going to be productive. As our risk tolerance changes, we need to make sure that we are changing our investments accordingly. And like Kaylee talked about, ideally this is a gradual process that we're able to implement over the course of multiple years. In some cases, if folks do come in and they're very close to retirement and have not done any of that, then sometimes it might involve some more significant changes. But in an ideal world, we can do it gradually over the course of multiple years.
Good. And I would guess the risk tolerance is somewhat of a moving target. Maybe you felt different 2 years ago than you did perhaps sitting here in 2025, right?
Indeed.
Absolutely.
Good. And what was the website they can go to take that?
They can go to retirewithbuska.com.
And it's short, 11 questions or something like that.
It is
too,
11
right?
questions, very easy to answer, take less than 5 minutes.
Excellent. So head out there and take that short questionnaire, get a handle on your risk tolerance. After a short break, we'll go into greater detail about how truly understanding your risk tolerance can make the financial planning process more efficient and responsive to your needs. We'll be back right after a short timeout.
And now back to our weekly question and answer segment.
Before the break, we highlighted that understanding your risk tolerance is one of the foundational elements of building a comprehensive and lasting financial strategy. Before the break, Ryan and Kaylee explained that it's often a smart move to reduce your investment risk as you move closer to retirement. Let's touch on that a bit more. Why is it harder to recover from losses as you get closer to retirement?
Yeah, so the issue, and one of the big reasons why you want to reduce your risk tolerance, particularly as you're getting into those final years before retirement, is because time is such an important part of investing. And if you have losses right before retirement, that may impact your ability to take income from those investments sustainably over the course of your retirement. Because while retirement itself is not actually a short-term period from an investing perspective, if your retirement is 20 or 25 years, that is quite a long time. But the short-term market fluctuations can have very significant impacts on the sustainability of your retirement due to something that we call the sequence of returns risk, which if you are experiencing losses, particularly early in retirement, when those funds need to last a much longer period of time, you can have perfectly solid average returns, but if you happen to lose a lot of money early on, you're then just working with a smaller pie with funds that you are also drawing on every single month. Because just because your IRA account is down doesn't mean you don't have to buy groceries that
My mortgage
month.
doesn't care.
Yeah,
Right.
the bank's not really too concerned with the value of your IRA once the mortgage is issued. And so that is why those losses, as we're approaching retirement, because then it shortens up our timeline for recovery, and then even early in retirement can be extremely damaging, which is why you need to make sure that your actual investment structure matches the appropriate risk tolerance that you should have as you get closer.
So I'm accumulating assets during my working years, and I'm just blindly putting money into 401ks and IRAs and just living life. How do I shift, blindly but close, how do I shift from growth to this income phase of life? What changes?
Yeah, so it's not just an actual change in the portfolio, but it's also a mental mindset change. So we've been in that accumulation mode, just pumping money into our accounts, but now we need to focus on how do we generate income and make that actual transition in the portfolio. So first, start by analyzing what you have in growth-oriented investments and then also what you have in income-generating investments. And from there, look at the performance of those investments. See how they've performed, especially during market downturns. And then, from there, see, have you overperformed, underperformed? Have you kind of kept pace with the benchmarks? And from there, you can see how volatile you are in your current investments and what you're currently generating. And then you can scale back a little bit, move some of those growth-oriented investments into more income generating. And so when we make that shift, it's going to be important to focus on the yield within your portfolio. So the yield is going to be focusing on the income that you're generating through the interest with your bonds, but then also the dividends that you can have with your stocks. So if we can bulk that up in retirement, that's a great place that retirees can siphon that income off and have that reliable income stream, or they can just keep reinvesting those dividends. And over long term, it's like dollar cost averaging and having a lower average share price.
Got it. So if in retirement you hear a statistic of 80% of your income or some type of thing, should people plan on reducing their income before retirement, reducing income at retirement, or?
Yeah, so it really depends on the individual's circumstances. So one of the things that we want to do, anytime that we're going to run an income plan, we want it to reflect reality as close as we possibly can. And honestly, one of the most difficult parts of that is having folks actually analyze their expenses, because we kind of just go through life. And a lot of times folks don't actually have a hard budget, or necessarily even if they don't have a hard budget, just know about what they're spending month to month. It just kind of happens in the background. And so one of the things that we always have clients do is make sure they actually look at, hey, what have my expenses been? And then we want to account for, okay, are there any expenses on here that might be coming off in the near future? The most common one for folks approaching retirement is, okay, maybe they only have to pay their mortgage for a few more years. Maybe they took out a 30-year mortgage when they were 35 and they're retiring at 62. So yes, their income needs will be a little higher for a few years and then they'll drop by some dollar amount. Other ones we don't want to necessarily just lop off. If you have an auto loan, well, you probably will have to get a different car at some point during the retirement process. So whether it's paying for that directly by a loan or saving to make that purchase, we want to account for that on the budget. Now, in most cases, we do see a reduction in retirement income needs for folks, because a lot of the things that were costing them more in expenses in their 50s per se aren't necessarily there in the 60s, whether that's mortgage, children still living at home. Turns out it's a lot cheaper to only have one or two people in the household rather than 3 teenagers on top of that. And so that's typically what we see, but the actual analysis of that and how it's going to apply to everyone is going to be very individualized. Some folks carry a mortgage well into retirement. Other folks have their house paid off by the time they get there. And so it's all going to be on an individualized basis.
And how can adjusting that risk, you guys talk a lot about not making emotional decisions and having a plan in place and coaching to the plan. How does having that, risk assessment and alignment in order help provide me peace of mind to not make the emotional decisions like that?
Yeah, absolutely. So if we can lower the risk within our portfolio and kind of reduce that exposure to the market, then when we experience, strong market swings like we have already this year, then you shouldn't have as much of an emotional response to it. You know that you've kind of tailored back on that exposure, and your portfolio should be handling it a little bit better than when you were in riskier investments. Also, if you've made that shift into some more income generating investments, then you know that you still have that income stream. Even if you're not touching it, you know that you're reinvesting, and in times of market volatility, you're basically buying at a bargain, which a lot of people like. Ultimately, though, what's going to bring you the most peace of mind is if you can answer what you have in your portfolio, why you have it in your portfolio, and then how it's benefiting you. If you can't answer those 3 questions, then you should definitely be sitting down with a financial services professional, because you want to have that peace of mind and that confidence going into retirement, knowing that you have a plan in place and it's going to address all of these different areas. And we don't want to have to adjust our income because we've experienced times of market volatility.
Sure. So even if I'm watching the news and calling a panic,
Yep.
you just tell me, don't worry, we've got a plan in place for that?
Got a plan in place.
Good. And so the income plan you have, does that actually detail out spending and how it works? And 'cause that's one thing I feel like we do as, consumers a lot, is we just save money, we don't really have a purpose for it, like you said. How does the income plan work?
Yeah, so the nice part about when you create a comprehensive income plan, it should be laying out where those income sources are coming from. So folks usually have a variety of different sources for their income. You'll have Social Security. If you have a pension, that'll be included. The big one when we talk about investing is going to be like account withdrawals, basically money you're pulling from your various different investment accounts. And then if a plan is truly comprehensive, it will have kind of sub-pages or follow-up pages that is going to include where that's going to be coming from, things that we might want to implement, whether it's from a risk perspective or from a tax perspective, to make sure that we're kind of optimizing the plan for that individual or couple's particular circumstances, to make sure that we're doing whatever is necessary to be efficient from that tax perspective, but also to make sure that our income is going to be sustainable long-term throughout the hopefully 25, 30 years of a retirement plan.
Well, good. Well, why don't head out to the website, take that short color money risk analysis, 11 questions, and we'll be right back after this with more Financially Speaking.
And now our Financially Speaking weekly desk segment.
Welcome back to Financially Speaking. I'm Sue Buska from Buska Retirement Solutions, and I'm here with Ryan Pekka. Today, we are going to be tackling a stressful but all too common situation: what to do when you've exhausted your emergency fund. Now, there was an Investopedia article entitled 5 Essential Steps to Take When Your Emergency Fund Runs Out, and it offers some real essential tips.
That's right. And folks running through their emergency funds happens more than people might think. In fact, an Empower survey found that nearly 37% of Americans can cover a $400 emergency expense. And over 1 in 5 have no emergency savings at all.
Wow, that's a little terrifying. And let's be honest, if you've used up your emergency fund, it can feel like a financial failure. But it's not, is it?
Great point, Sue. It's definitely not a failure. After all, emergency funds are meant for emergencies. The real question isn't whether you use it, it's the steps you take once it's gone.
Yeah, so let's break it down. What's the first step if someone's run out of their emergency fund?
Sure. Step 1 is what Investopedia calls an emergency budget overhaul. Basically, it's time to build a new budget that reflects your current reality. Not what you wish you could afford, but what you can afford.
So not just trimming around the edges.
That's right. You need to reprioritize everything. Eliminate non-essentials, recurring expenses, shift funds to cover immediate needs, and even get creative. The article mentions things like Ramen Tuesdays or no spend weekends to help build discipline.
Ramen Tuesdays? Well, I remember those from college. What's next?
What's next? Step 2, contact your creditors proactively. Don't wait until you miss payments. Reach out as soon as you know you're going to have trouble. Many lenders offer hardship programs that can lower interest rates or adjust terms for a few months.
And that gives you some breathing room, right?
Exactly. Just don't accept the first offer out of panic. Explore your options and don't lock yourself into something with high interest debt just because you're stressed out.
So budgeting and communication. What's step 3?
Sure. Pause other financial goals. It's okay to take a break from aggressive savings or investing. Just make sure you're still contributing enough to get any employer match if you have a 401k.
And so you're not abandoning your long-term goals, you're just hitting the snooze button.
Exactly. As a financial coach, Netta Stahl, says in the article, it's a season, not a permanent lifestyle. Set your milestones so you know when to resume your normal contributions.
And that makes sense. So, okay, what's step 4?
Step 4 is to boost your income. This is where freelance work or a side hustle or some kind can really help. Platforms like Upwork, LinkedIn, or Fiverr can connect you to some side gigs in your industry or help you try something new out.
So if you have skills in writing or virtual assistance design and so on, you can turn that into real money.
Definitely. Just remember to track all your freelance income for taxes. If you like driving, picking up some work with rideshare apps like Uber, or delivering via apps like Instacart or DoorDash, are other great ways to bring in some extra cash.
And that brings us to the last step.
Step 5, turn unused assets into emergency capital. Think beyond just selling stuff on Facebook, Marketplace. Look at digital assets, unused subscriptions, reward points, even renting out high-value gear on peer-to-peer platforms.
Well, that's creative, and I never thought about renting out a camera or a musical instrument.
Right? It's all about conducting an asset audit to uncover hidden value. Just don't try to invest your way back with risky assets like crypto. That defeats the whole point of emergency savings.
Yeah. So the bottom line is take action, stay calm, and remember that using your emergency fund doesn't mean that you have failed. It means that you did its job.
Exactly. Rebuilding it takes time. Most people need about a year to replenish a 6-month fund, but with the right strategy, you'll get there.
So you're in that boat. Don't go it alone. Reach out to a financial professional for help with rebalancing, budgeting, or finding side income. You've got options.
That's a great point. Sue, we've talked about how to recover when your emergency funds run out, but sometimes the best way to stay afloat is by avoiding the mistakes that drain your wallet in the first place.
Well, that's right, Ryan. There's a great article on Investopedia that walks through the common financial mistakes people make, especially when money's tight. And if you can steer clear of just a few of these things, you can save yourself a lot of future stress.
So let's kick it off. What's mistake number 1?
Well, unnecessary spending. We're not talking about treating yourself now and then. We're talking about habits that quietly add up. That daily coffee, a streaming service here, a dinner out there, $25 a week adds up to $1,300 a year.
Whoa, and that's money you could be using to pay down debt, build savings, or cover essentials. But like you said, if that cappuccino keeps you sane and it fits in your budget, go for it. Just be intentional about it.
Right. Exactly. The key is don't accidentally spend money you don't have.
All right. What's mistake number 2?
Well, never-ending payments. Think subscriptions, high-end memberships, anything that keeps charging your account month after month when things get tight. Ask, do I need this, or is there a lower cost alternative?
A gym is a great example. You might not need the one with eucalyptus towels and a smoothie bar if there's a solid community rec center down the street.
Amen. On to mistake number 3, living large on credit cards. Using credit to cover everyday expenses or luxuries you can't afford. That can dig a serious hole fast.
Especially with rates being so high. According to the same article, the median interest rate on credit cards right now is over 24%. That makes every purchase more expensive than it looks.
And if you can't pay it off in full every month, that debt does start to snowball.
Okay, let's talk about cars.
Oh, mistake number 4, spending too much on a vehicle. Financing a big SUV might sound great, but it's a depreciating asset. You're paying interest on something that loses value the second that you drive it off the lot.
And then there's insurance, gas, maintenance. It all adds up. If you don't need a big car, go with something smaller, more fuel efficient.
And the same idea applies to mistake number 5, spending too much on your home. Now, bigger homes mean bigger bills. You'll spend more on taxes, utilities, upkeep.
Before you buy, think beyond the mortgage payment. Can you comfortably afford everything around the house too?
And mistake number 6, misusing home equity. Refinancing or using a HELOC might help in the short term, but it comes at a cost. You're basically trading future security for right now spending.
If you're going to tap into your home's equity, make sure it's for something essential and not just to plug a budget hole.
Next up, not saving. This one's simple but huge. Even if just a little bit each month can help you stay prepared for emergencies.
A savings buffer can be the difference between staying afloat and spiraling into debt if you lose your job or have an unexpected expense.
And mistake number 8, not investing in retirement. If your money isn't working for you, you might be working forever.
Even small contributions to a 401k or IRA can be a big difference over time. And if your employer matches or offers a match, that's free money on the table.
And mistake number 9 hits hard. Paying off debt with retirement savings. Now, it sounds smart on paper, but it often backfires. You lose out on compounding interest, you pay penalties, and it's tough to rebuild.
That's right. If you do borrow from retirement, treat that like a debt you owe yourself and stick to a plan to pay it back.
That's exactly right, Ryan. And finally, mistake number 10, not having a plan. You wouldn't take a road trip without a map, right? So your finances need one too.
That's right. Even a basic plan can help. A financial advisor can help you if you're not sure where to start.
Look, we get to life and it happens. Some things are out of your control, but a lot is in your hands. And avoiding these common mistakes can help keep you on a steady path.
And if you've made some of these mistakes already, don't beat yourself up. Learn from it, adjust, try again.
Exactly. And if you want help creating a financial plan that works for you, reach out to us at retirewithbuska.com or call 715-355-4445. We'd love to help.
We'll be back with more Financially Speaking after this.
Thank you for tuning in to this week's edition of Financially Speaking. We're glad you were able to join us today, and we hope you learned some useful retirement tips along the way.
On today's show, we covered a number of important topics, and hopefully we did so in a manner that was easy for you to understand. This is the same way we communicate to our clients when we meet with them in person. Remember, with the help of the right financial services professional, you can create a quality retirement, and our team is here to help. Right now may be a great time to get a second opinion on your retirement plan. Call us at 715-355-4445 or go to retirewithbuska.com to continue retirement education, catch up on previous episodes of our TV or radio show, or schedule your complimentary, no obligation consultation.
If you have any questions or comments about today's show, call us at 715-355-4445 or feel free to send us an email at info@retirewithbuska.com. Join us next week at the same time and the same place for another episode of Financially Speaking.